Welcome to The Explainer. Today, we're diving into a signal that often comes right before some of the market's most explosive moves, the volume spike. We're going to show you how to spot the heavy stomps of the big players before they make waves.
So, what if a chart could literally tell you when a big move is about to happen? I mean, seriously, imagine you could see the market building up all this pressure right before a massive price explosion or a super sharp reversal. Well, that's exactly what we're talking about today. We're going to dig into how a sudden surge in trading volume can give you that critical heads up, helping you anticipate, not just react to, those major market shifts. All right, so here's our game plan for today. First, we'll cover what a volume spike even is. Then, how to spot the signal. After that, and this is crucial, how to confirm it with price action. From there, we'll talk planning your trade, smart risk management, and we'll wrap it all up with a final takeaway. Let's jump in.
All right, first things first, what is a volume spike, really? It's way more than just a big bar on your chart. Understanding the why behind it, that's the real key to using it effectively.
So a volume spike is pretty much what it sounds like. You see this dramatic, unusually high bar pop up on your volume indicator. But listen, this isn't just random market noise. It's often the fingerprint of the big players. We're talking institutional money, hedge funds, you name it, either jumping into or getting out of the market in a huge way. And that is why it absolutely demands our attention.
I absolutely love this analogy. Think about it. If normal, everyday trading volume is like the daily footprints of buyers and sellers, then a spike is like a giant stomping into the room. It's this sudden, heavy presence that just forces you to look up and ask, whoa, who just showed up and what are they about to do?
Okay, so we get the concept right, a giant stomp. But how do you actually spot one of these on a live chart? Let's get practical and break down how to read the charts for this exact signal.
Spotting a spike is really all about context. You're on the lookout for a volume bar that just towers over its neighbors. A good rule of thumb, look for volume that's at least, say, 2 or 3 times the recent average. You can use a 20-period moving average on your volume indicator to see this easily. It's not just any tall bar, it's a total anomaly. And you'll often see them pop up right around major news events or the opening bell of a market session.
Now listen up, because this part is absolutely critical. This is where so many traders get it wrong. Spotting the spike is only half the battle. Think of it like this. The volume spike tells you there's a huge amount of energy building up, right? But it doesn't tell you which way the blast is going to go. For that, you have to look at what the price itself is doing. And this slide just lays it out perfectly. Look at the two scenarios. On one side, you have a confirmed spike. You get this huge surge in volume that pushes the price cleanly through a key resistance level. That price ceiling the asset has been struggling to break. That is a powerful breakout signal. But then, on the other side, you have the false alarm. You get that same huge volume, but the price just smacks into that ceiling and gets slammed right back down. We sometimes call this an exhaustion spike or climax volume, and it can actually signal a reversal. See? Same volume, but the price tells a completely different story. And this quote from our source, the Forex Geek, just nails it. It brings the whole thing together. It's a simple 3-step mantra. Spot the volume, confirm with price, then execute your plan. That really is the core of the entire strategy.
Okay, so now for the really practical part, how do we turn this observation into an actual actionable trading plan? This is where we go from just watching the market to having a repeatable strategy.
Here's your 4-step playbook. Step 1, identify the spike. Simple enough. Step 2, confirm. And please don't jump the gun. Wait for that candle to actually close above resistance or below support. Step 3, enter. And you only enter after you get that confirmation. And then, maybe the most important part, step 4, manage. You need to know your exit plan, both your stop loss and your profit target, before you even think about clicking buy or sell. This isn't about gambling. It's about disciplined execution.
All right, you could have the best signal in the entire world, but without this next piece, I promise you're pretty much guaranteed to fail in the long run. Let's talk about smart risk management. This is how you protect your capital so you can stay in the game.
And this isn't just some motivational quote to put on a poster. It is the absolute foundation of a trading career. Volume spikes mean high volatility. And yeah, that volatility can be your best friend when it comes to profit potential, but it becomes a huge enemy if you're not managing your risk. Your number one job isn't to chase profits. It's to protect your capital from that very volatility.
So how do we actually do it? First, a stop loss is non-negotiable. Always use one. A good spot is just beyond a recent price swing that gives the trade a little room to breathe but gets you out if you're wrong.
Second, adjust your position size. If the market is whipping around like crazy, you trade smaller. Don't risk your usual amount in a more dangerous environment. Third, you gotta kill your FOMO, that fear of missing out. Chasing a move that's already halfway to the moon is just a recipe for buying the top. And finally, and I know we've said it before, but it's that important, define your exits before you enter. Know your pain point and your profit goal right from the very beginning.
Okay, so let's boil all of this down. After everything we've talked about, what is the single most important thing to remember about this entire strategy?
It all comes down to achieving one core goal. And here's the real value. This strategy, it's not some magic formula for printing money. Think of it more like a training tool. It forces you to be disciplined. It forces you to watch both volume and price, to be patient and wait for confirmation, and to always manage your risk. Ultimately, mastering this makes you a better, smarter trader because it teaches you to truly understand the story the market is telling you. And that brings us to our final question, which is really a question for you and your own trading style. Are you the aggressive type of trader who acts on the spike itself? Or are you the more patient one who waits for that full price confirmation? You know, there's no single right answer here, but knowing which one you are, that's key. Thanks so much for joining this explainer.